IFRS and Corporate Reporting webinar for 2026. Thank you for joining us. Today we are continuing our 2026 BDO IFRS and Corporate Reporting journey through IFRS 18, presentation and disclosure and financial statements. However, as always, before we dive into IFRS 18, let's cover off some housekeeping matters first. For those of you that are new to the BDO IFRS and Corporate Reporting webinars, my name is Dean Arden. I'm one of the partners in the IFRS and Corporate Reporting team at BDO, located in the Melbourne office of BDO. I work with a range of for-profit and not-for-profit entities on a broad range of accounting and financial reporting matters, including IFRS 18. As always, we acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to the elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples joining us today. Now, I'm presenting this webinar from Melbourne, or NAM, the traditional lands of the Wurundjeri Woi-wurrung or the Bunurong Boon-wurrung peoples who are part of the broader Kulin Nation. The picture of this on this slide is of Davies Creek in the Atherton's tablelands in North Queensland. Davies Creek is the traditional lands of the Buluwaye people of the Kurunda on the Atherton tablelands. Beautiful area of Australia, Atherton tablelands. I've been there years ago. I hope it's still as beautiful still as beautiful now as it was then. As I mentioned in the webinars to date this year, apart from our traditional 30th of June and 31st of December financial and sustainability reporting updates, we've dedicated the remainder of the webinars this year to IFRS 18. So if you haven't already signed up for all the webinars this year, good time to lock in those dates and times in your calendar. Today we're looking at beyond the profit or loss, the broader impacts of IFRS 18. So up to this point in time, we've been really dealing with the profit and loss implications of IFRS 18 and restructuring the P&L under IFRS 18. Next month, we have our traditional 30th of June reporting update on all matters financial and sustainability reporting, where I'll be joined by Aletta Boshoff, who's the national leader of the IFRS and Corporate Reporting team here at BDO in Australia. With regards to sustainability reporting, we also have a full program this year. So Group 1 entities are currently starting to finalise and publish their first sustainability reports. And Group 2 entities should be well on the way, given they have a 1st of July 2026 start date. So if you are a Group 2 entity, now is the ideal time to join our sustainability webinar series. This month, Aletta Boshoff and Claudia Wazowski are going to explain how entities can strengthen governance for climate risk and sustainability reporting. I've mentioned in a number of past webinars, BDO Global has updated its IFRS 18 in practice publication. So it's now available via the BDO Global website and via also the Australian BDO website. The updated version has benefited a lot of input from BDO Network, thinking about how IFRS 18 might impact different entities and their discussions with clients and other firms as well. So there's also a range of articles available from our Corporate Reporting Insights publication on IFRS 18, which you can subscribe for through our BDO Australia website. If you've been listening to past webinars in this series, in each CRI, that's the Corporate Reporting Insights edition newsletter, the edition we've published this year, I've been including a short focused article covering one or two of the more challenging aspects of IFRS 18 that I discussed in the client webinar immediately preceding that CRI edition. So if you've been listening to the webinars and there's been something in there that you maybe didn't quite pick up or that you wanted to read further on, have a look in the CRA publication, because there's likely to be an article covering something that we've discussed in the webinars to date. With regards to the masterclass, we had our first masterclass on Friday, the 27th of March, 2026. It went really, really well. As a consequence of that, we did a lot of work on updating the balance sheet. Updating the profit and loss statement. We worked through a really quite good practical example, and there was a lot of good feedback. I think the key thing with it, and I haven't mentioned there, you can still enrol certainly in the masterclasses. It's available still on the BDO website. At this stage, I will be probably putting repeating the transitioning your profit or loss to transitioning the profit or loss statement to P&L to IFRS 18. I'll be probably running a second masterclass of that, and as a consequence, that one should be really interesting to attend. We got really good feedback from what we've done. The next one coming up is transitioning your balance sheet and cash flow statement to IFRS 18, which is due to occur on Friday, the 29th of May, and transitioning your management defined performance measures, which we've scheduled for Friday, 31st of July. If you are concerned about, it's because you've missed that, obviously the first one, the transitioning your profit or loss, like I said, I will be putting up we'll be repeating that session probably around October, just to try and avoid the audit and financial reporting period requirements, but also probably running it more towards midday to ensure that we can sort of give people from maybe the western side of Australia an opportunity to attend. Now, so today's topics. They've been selected to provide you with an introduction to transitioning your balance sheet, your notes to financial statements and your cash flow statement to IFRS 18. This material is largely new to this webinar series, so I haven't covered these topics before. So what we're going to look at today are the topics substantially unchanged from IS 1 and retained within IFRS 18, largely unchanged. Topics retained from IS 1 but relocated to another accounting standard. New topics introduced in IFRS 18, so IS 7 and IS 33. Consequential amendments arising from IFRS 18. The roles of the primary financial statements and notes, financial statements as structured summaries, new principles of aggregation and disaggregation, nature and function of expense classification and disclosures and presentation, and new expense disclosures. A word of warning, and this is possibly a veiled apology as well. Today's slides are pretty wordy, particularly in comparison to what we've done in the past. I did try to make them more visual and introduce diagrams, but look, despite mine and co-pilot's best efforts, we weren't really able to come up with much that was particularly useful, or that I felt was particularly useful. So, or that I thought would actually assist, or that could, I could comfortably talk to. So, apologies in advance. The slides today are very wordy, but the upside is though that I've tried to keep the number of slides to today's presentation fewer than normally the case, which I think will allow just to make it a bit more time today, and it allow us to walk through the concepts a little bit more, with a little bit more detail and with a little bit more time to actually think and digest those things. Thanks to everyone who have sent through questions to date. I've attempted to answer the ones that I've received and that I can answer, and as and when basically I've covered the relevant topics within the webinar program. So that means if you've actually sent in question and you haven't heard me respond to it, I'm likely still hanging on to it until I actually present on the relevant webinar or the question. On the matter of questions, we did receive a question asking about the potential implications of the objective of financial statements as detailed in the conceptual framework for the objective of financial statements as detailed in IFRS 18, and hopefully I'll be able to satisfactorily actually address that question today. So without further ado, let's go beyond profit or loss. So in the vein of, do you want to hear the good news or the bad news first? Let's start with the good news. Many requirements in IS 1 were brought forward into IFRS 18 or into another IFRS standard, basically substantially unchanged. A significant number of requirements in IS 1 have also been relocated substantially unchanged to IS 8, which is now called, or which will be called, when IFRS 18 becomes effective, basis of preparation of financial statements. Now let's look at these retained requirements. This slide provides a summary of all of the topics that were retained from IS 1 in IFRS 18. Now, based on the contents of this slide, it seems like a lot of topics were retained, and they were. That's actually a fair statement. It's worth remembering that the rewrite and the replacement of IS 1 with IFRS 18 actually focused on presentation and disclosure of profit or loss items. So unsurprisingly, many of the topics in IS 1, particularly those either related to the primary financial statements other than the profit or loss statement, and those that not really related to any particular financial statement were actually retained. So the ISB didn't really look at any of the other requirements in IS 1 except that those that directly related to the profit or loss statement. So if we just walk briefly through the retained topics, we start at the top left-hand side of this slide. The topics and requirements that have been retained include, so the complete set of financial statements for reporting periods. So you shouldn't be expecting to see under IFRS 18 new statements. They haven't been introduced in the standard. IFRS 18 continues to require a single statement of profit or loss and other comprehensive income in two sections, or statement of profit or loss and separate statement of comprehensive income. So it's still profit or loss statement with the OCI still looks very similar. The clarification of the role of materiality in determining what information is to be presented or disclosed under other IFRS accounting standards. Again, same thing, We always had materiality, it's the same materiality. Information clearly identifying the financial statements, each primary financial statement and notes, name of the reporting entity, whether the financial statements are of an individual entity or of a group, consolidated financial statements, the balance date of the entity, the presentation currency of the entity, and the rounding factor of the entity. Again, all the same, no changes. The circumstances under which an additional line items and subtotals would be presented. Now, that's been retained, so there is still that capacity to do that, but I will talk about later in the webinar, we'll talk about the fact that the criteria that you need to meet in order to add that additional line, an additional line item or a subtotal, have actually changed. So yes, the general ability to do it still exists, but there is some changes in the criteria that have to be met. Still the same frequency of reporting, the requirements around those, consistency of presentation and classification, comparative information, circumstances under which a third balance sheet are presented. So if it's a reclassification or a voluntary change in accounting policy or an accounting error, the circumstances where offsetting can occur. So IS1 previously had requirements or currently has requirements around, they're very general requirements, but they're requirements around when you can offset assets and liabilities or revenues and expenses and present them as a single item. Line items to be presented in the statements of financial performance, financial position, and changes in equity. And I've got in the brackets except for goodwill. So there's only one minor change, but it is still a change. Those old paragraphs in IS1 that specified, the line-by-line disclosures that should be appearing in your profit and loss and your balance sheet, they've been retained effectively. But with regards to the balance sheet, there is that exception that now, previously IS1 just simply mentioned intangible assets. Now goodwill has been identified separately in that list of things that need to be identified. But again, the criteria around applying that has changed too. So be aware of that. I'll come back to that topic. But so the line items have still been retained, the requirements about line items, but how you apply them is slightly different under IFRS 18. Classification of assets and liabilities as current and non-current hasn't changed. Other comprehensive income presentation requirements, again, unchanged because the ISB did not deal with OCI. Structure and broad contents of notes, again, the requirements around those haven't changed. Capital disclosures, which you often see really probably most applicable to entities that have regulatory capital, they have remained. And the disclosures around equity, so share capital, entities without share capital and dividends have been retained. So all of those things are still the same. So you wouldn't expect to see necessarily any great changes in your financial statements or in the reporting requirements that apply to your financial statements as a consequence of IFRS 18 for any of those. What else hasn't changed? So if we look a bit more deeply and broadly to other standards that receive some IS1 topics, the rewrite of IS1 also gave the ISB an opportunity to contemplate the best home for some topics and requirements that were in IS1, but possibly only because at the time it was the easiest standard to locate them in. So I mentioned before that IS1 will, in the same year, entities mandatorily transition to IFRS 18 be renamed basis of preparation of financial statements. So it's got a very different name than what it currently has. So consistent with this new name, the ISB have decided that IS1 will be the best home going forward for a couple of topics currently located in IS1, those being fair presentation and compliance with IFRS accounting standards, the going concern disclosure requirements. So if you're not a going concern, you have to say what's the basis of your preparation, disclosure of accounting policy information, and disclosures about judgments and sources of significant estimation uncertainty. So again, those requirements have been largely just lifted and relocated and will appear in IS 8 going forward. But at this stage, they are going to be unchanged. So again, it shouldn't impact the way you prepare your financial statements under IFRS 18. The ISB will also, and I think appropriately, decided that considering the relationship between puttable instruments and financial instruments more broadly, the logical place to relocate the puttable instruments disclosure requirements that currently sit within, I think it's paragraph 136A of IS1, is IFRS 7. And so as you can see in the slide there, they've relocated effectively those disclosures about puttable instruments classified as equity into IFRS 7. And it makes sense to put them in there because puttable instruments are sort of like they are a financial instrument, and they're just an unusual type of financial instrument. So again, unchanged if you've got puttable instruments, not many people do, but generally the other requirements around fair presentation, going concern, accounting policy and judgments and significant estimates, all again, the requirements are still the same, just been relocated to IS 8 and it's been renamed. So if you don't like change, this is where the good news ends. If on the other hand, if you like or love change, this is where the good news starts with the brand new topics introduced in IFRS 18. So if you have a look at the new topics introduced in IFRS 18, and I will come back to some of these in more detail later in the webinar, but maybe just as an overview, we'll just sort of skip through these so you've got a bit of a sense of what has changed. At the very top there in the top left-hand corner, I started out with a specification of the objectives and roles of the primary financial statements and notes to assist in distinguishing information to be included in the financial statements from that to be included in the notes. Now, this has been an ongoing issue for the ISB. The ISB have always had this issue around queries to what should be in the face of the financial statements versus disclosed. Now, when I started off working in standard setting, we had very, very distinct language based on presentation and disclosure. So presentation, my understanding, when I started in standard setting, presentation meant, and we don't use the phrase anymore, but meant on the face of the financial statement. So it actually appears on the face of the financial statement. Disclosure could mean either on the face of the financial statements or in the notes. But if you said presentation, then that was specifically related to on the face. Now, disclosure, I've noticed over the time, the word disclosure has sort of been used loosely in some standards over time in the drafting. And so as a consequence, sometimes it does refer to note disclosures, just specifically. Sometimes it's just presentation. So the ISB have really decided that they have to sort of, sort this out because it does make a difference to to obviously compliance, and it makes a difference to where entities, how they present their financials. So they've put a bit of effort into it, but they've gone back to almost basics to try and develop some conceptual basis from which entities can then use to actually determine when I'm faced with a particular reporting requirement, do I include it on the face of the financial statements or notes? They've also added the role of providing a useful structured summary in identifying the specific requirements with which the primary financial statements should comply. Now, they're doing this again to in part address that issue about what should be on the face of the financial statements and what shouldn't be. Or whether, if there's a choice, how do you make the choice? Like, how do you determine the distinction between the two? So again, it's useful guidance, but it's different to what was the case previously because, you would be aware the ISB have been dealing with this issue for some period of time. Consistency of disclosure in addition to presentation and classification. Changes in disclosure in addition to presentation and classification. Principles of aggregation and disaggregation. We certainly haven't had those before. That's new as far as the ISB is concerned. And it does sort of work, and it sort of dovetails in with the issue about how do I distinguish between presentation and disclosure, and how do I understand when I'm meeting a presentation or disclosure requirement, how do I do it with a group of items as opposed to a single item? Separate line presentation of goodwill from intangible assets. And I mentioned that before. That's just an extra line that's been added into the paragraph, the relevant paragraph in IFRS 18. Items to be disclosed if not presented in the profit or loss. Accounting policy to use either or both nature and function as a basis for classifying and presenting expenses. I'll come back to that topic later in the webinar, but again, that one's been one that's been outstanding for quite a period of time. It's been a sort of probably a bugbear of many auditors, many preparers for a long time. I think preparers have generally taken the view that the current requirements where it has to be expense has to be classified on nature or function. I think a lot of preparers regard that as a bit restrictive and not particularly in the best interests of users. And auditors, I think, have also looked at this from a materiality perspective and generally deal with it that way. Broader and more detailed disclosure requirements for total expenses for specific categories. So for property, plant, and equipment, or investment property depreciation, tangible assets amortization, employee benefits, impairments, losses, reversals, inventory write-downs and reversals. The amount of each total recognised as expense and if applicable not recognised as an expense. So this is a sort of new one, but it's sort of integrated with the dot point above. So as a consequence of breaking down these requirements and distinction between classifying based on nature or function, having things in function can sometimes hide expenses which the ISB thought, well, not hide, but not necessarily make them clear as to what they are. So as a consequence, the ISB have thought we need to introduce some additional disclosure requirements so people can sort of see through some P&L to see what sort of individual expense lines look like. And disclosures applicable to management defined performance measures. Now, consequential amendments. we look at the consequential amendments to other standards arising from, sorry, something's just turned on, I better turn that off. Consequential amendments to other standards arising from IFRS 18. So just as an overview, probably the two key standards that are going to be impacted by that are amendments to the IS7 and amendments to IS33. So IS7, unsurprisingly, because IS7 and obviously the profit and loss statement are integrated in the sense that they are linked when you prepare your, particularly when you prepare your reconciliation of your cash flows from your operating activities with your cash flows in your statement of profit or loss, or sorry, statement of cash flows. Previously, entities that used the indirect method would use profit or loss as the opening line item, but obviously under IFRS 18, the opening line item will be actually operating profit or loss now going forward. So that is, you'd expect if you were now preparing under IFRS 18, you'd expect to see different line items to reconcile operating profit or loss with cash flows from operating activities. And also, and this is just for those entities that are dealing with preparation of Australian accounting standards, entities are required to disclose the indirect method if not presented in the cash flow statement. So this is actually going to have quite significant impact for Australian entities, say, relative to other entities, particularly because we have that requirement that we do both. Unless you're doing tier 2 entity financial statements, if you're doing tier 1 under Australian accounting standards, under IFRS, under strict IFRS, there's a choice, but under Australian accounting standards, we actually do both. Both preparations. So as a consequence, you need to be aware that that will be impactful on those entities. The other thing that IFRS 18 does, it eliminates the classification options for interest and dividend cash flows. So as discussed in probably the last 3 webinars, we've gone through how, as a consequence of the requirements under IFRS 18, interest and dividend cash flows, so interest paid and interest received and dividends received, are potentially classifiable under either operating or, in this case, financing or investing, subject to the nature of the asset and potentially the operations of the entity, the specified main business activity of the entity. So as a consequence, you need to be aware that also those items, there's no longer that choice available when you're preparing your statement of cash flows around what you do with your interest and dividend cash flows. The amendments to IS33 are quite interesting but significant in a sense if you are a listed entity or an entity that otherwise prepares earnings per share numbers. So if you don't prepare earnings per share numbers, obviously it's not going to be impactful. But if you do prepare earnings per share number, previously entities could disclose additional earnings per share amounts using a reported component of a statement of comprehensive income as a numerator. Now, under IFRS 18, entities are permitted to disclose additional earnings per share amounts, but only when the numerator, so that's the entity, that's the number on the top of the fraction, is a total or a subtotal specified in IFRS 18 paragraph 69. So the operating profit or loss before financing, and other income taxes or profit or loss. So there's only very specific subtotals that can apply there. Or IFRS 18 paragraph 86, so profit or loss, other comprehensive income or comprehensive income. Or IFRS 18, so paragraph 118, subtotals of income and expenses not management defined performance measures. Or it is a management defined performance measure. Now, I haven't talked about management defined performance measures, but we will be talking about them in a couple of months in the context of IFRS 18. But let's say for the time being that management defined performance measures are a measure of management's performance it's a performance, so it's based on revenues and expenses, and it's not otherwise an IFRS number. So I'll use that for the purpose of this webinar, but management defined performance measure is excluded in this case. Is included in this case, and it's only to be recognised if they are those. Additional disclosure requirements apply when the additional amounts per share, other than the basic and diluted earnings per share, are disclosed. So, e.g., adjusted operating profit per share. Now, disclosure requirements are more significant if disclosed additional per share amounts use the management defined performance measures as a numerator. Now, the reason for that is because management defined performance measures are actually subject to additional disclosures, even if they are a numerator in an earnings per share or earnings per share like measure. So as a consequence, it's almost like a double disclosure requirements applying to it. Now, role of the primary financial statements and the notes. So let's look a bit deeper at some of the key changes introduced by IFRS 18, and we can actually start with the role of the primary financial statements and the notes. Now, Without going into too much detail, and I don't want to sort of throwing this big slide again, apologies for the level of words in this, but I couldn't sort of identify a way that I could possibly convey this information in a way that's more effective. On the left-hand side of the screen, you can see IS1 paragraph 9. Now, that is a really quite long and detailed paragraph dealing with the objective of financial statements under IS1. It's interesting in the sense that, and maybe they use co-polls or not, I'm not sure, but it looks like they've reduced that IS1 paragraph 9 paragraph quite significantly down to its corresponding one, paragraph 9 in IFRS 18, quite effectively. But what they've done, and I've made some references to the removals, but I suppose we just quickly look at paragraph 9. The objective, it states, is financial statements are structured presentation of the financial position, performance of an entity. The objective of financial statements provide information about the financial position, financial performance and cash flows of an entity that's useful to a wide range of users in making economic decisions. Financial statements also show the results of the management stewardship of the resources entrusted to it. To meet this objective, financial statements provide information about the entity's assets, liabilities, equity, income and expenses, including gains and losses, contributions by and distributions to owners in their capacity as owners, and cash flows. This information, along with other information in the notes, assists users of financial statements in predicting the entity's future cash flows and in particular their timing uncertainty. Now, in transitioning to IFRS 18, the ISB looked at this objective and thought, what's useful, but it's pretty wordy, I think. And they probably realised that it's probably not that consistent with what was going on. So at the same time that the ISB were doing this work on IFRS 18, they're actually doing the work on the conceptual framework as well. And so the paragraph that appears under the title there, IFRS 18, paragraph 9, that is actually aligned with the corresponding objective paragraph in the new conceptual framework document. So it's pretty clear the objective of financial statements to provide financial information about a reporting entity's assets, liabilities, equity, income and expenses that's useful to users of the financial statements in assessing the prospects for future net cash inflows of the entity and in assessing management stewardship of the entity's economic resources. Now, from those, when you compare those two paragraphs, it's quite telling because I've just dot pointed some of the things that have been removed there. So the ISB's removed references to financial position, performance, wide range of users, economic decisions, gains and losses, contributions by and distribution owners, and notes. They're really honed down on exactly what it is that they think that the financial statements deal with. And they are effectively what they've listed there: assets, liabilities, equity, income, expenses, and expenses. So they've really kept it to the basics. And you'll probably understand why when I sort of as we move through this presentation, but it's really to enable the ISB to distinguish between what they see as a structured presentation of a primary financial statement and all other information that would be otherwise prepared and provided in the notes. The IFRS 18 objective paragraph also clarifies financial statements facilitate the provision of useful information in assessing the prospects of future net cash inflows. So it's really focused on what's the prospects of the entity as well. It'll make more sense when we probably look at a few more paragraphs and a few more changes the ISB made, but it's really focused on the fact that the ISB is saying, look, the face of the financial statements needs to be structured, and it needs to basically just deal with what we think should be on the face of the financial statements for the purpose of users, and particularly around what do we think the future net cash inflows are going to be. IFRS 18 has more specific guidance in respect to the roles of the primary financial statements and notes. Now, from this slide, you can see that as specified in IFRS 18, the role of the primary financial statements is to provide structured summaries of reporting entities' recognised assets, liabilities, equity, income, expenses, and cash flows, and that are useful to users of the financial statements. 4, obtaining an understandable overview of the entity's recognised assets, liabilities, equity, income, expenses, and cash flows, making comparisons between entities and between reporting periods of the same entity, and identifying items or areas about which the users of the financial statements may wish to seek additional information in the notes. Hopefully you can take from that paragraph 16 now, this is where it's sort of linking up. So first we have the objective, and then it's saying, okay, so if the objective is this, the sort of more finer objective of your financial statements, so that is your primary financial statements, is to provide a structured summaries of the reporting entity's recognised items. This is really interesting because it's really honing down where the various information should lie, or the way, the mindset that you should take as a preparer when you're thinking about what should be on the face of the financial statements and what should be in the notes. So if you have a look at paragraph 17 there on the right-hand side, the summary of it, paragraph 17 of IFRS 18 says to provide material, so the notes the financial statement, their objective is to provide material information necessary to enable the user of the financial statements to understand the line items presented in the financial statements and to supplement the primary financial statements with additional information to achieve the objective of financial statements. So it's interesting that in terms of the objective, what the objective is really focused on both the financial statements and the notes. But in this case, we're saying, okay, when we're looking at the primary financial statements, those three items, A, B, and C, are what we should be focusing on as in determining what goes into those financial statements. And everything else, subject to materiality, then sort of heads towards the notes. I'll discuss in more detail later, but specifying the roles of those primary financial statements in the notes, it actually plays the purpose of providing benchmarks. And that's probably what the point I was trying to make just then was is that they're benchmarks against which entities will now be expected going forward under IFRS 18 to assess their presentation and disclosure practices. So based on those defined roles of the primary financial statements and notes, say information presented in the primary financial statements is more aggregated than the note disclosures. Further from this slide, you can actually see the purpose of the financial statements is to provide users with summarised information and enable them to form a basis for understanding and comparing the entity with other entities and with that entity over time. It's interesting that understandability has actually been inserted in that discussion. And it comes from that understandability aspect comes from the conceptual framework. It's included here in the description of the role of the primary financial statements, which therefore suggests it's a qualitative criteria. So when an entity is sort of considering about what do I put on the face of my financial statements, the interesting thing is understandability is in itself sort of, it implies how do I apply or how do I interpret understandability, whether I'm looking at the face of the financial statements or the notes. Obviously, the notes, understandability, we always think about the notes as understandability in terms of, oh, there's more detail there. But what this does also says, well, look, when you look at the face of your financial statements, the face of the financial statements have to be understandable as well. You can't rely on the notes necessarily to fix whatever understandability issues might arise if people don't understand when they're looking straight at the face of the financials. We always understand that notes provide provide more detailed information. But interestingly, the ISB have sort of made it clear that it has to be material information. So the notes don't include immaterial information about the contents of the maybe interesting line items in the primary financial statements. Another interesting point about this distinction between the role of the primary financial statements and the notes, the materiality requirements set out whether an entity is required to provide information, but they don't actually set out where in the financial statements that information should be provided. And that's because information presented in the primary financial statements and in the notes are both expected to be material. So again, it's an important reminder, but I suppose it's in the context of where the ISB is we've been with a lot of this work around that they've done over the last almost 20 years with IS1. It's almost a lot of that work has really been focused on identifying materiality, making the distinction between the notes and the face of the financial statements, making sure all the information is actually really clear and understandable to the user, and making the financial statements along with the notes much more usable in the way that the users are trying to use them, not necessarily in what we think that they should be including. I'll talk about it later, but these requirements around the objective and the roles of the primary financial statements interact with and actually help to facilitate the application of the requirements dealing with actually determining the usefulness of structured summaries of information in the primary financial statement. So I'll come back to that, but it's at this stage, hopefully you can start to see the way the ISB's thinking starting to come together, the way that they're sort of structuring their thinking and the way that they're asking you to think about when I prepare my financial statements and I have to think about what's in those financial statements, how do I do it? Look, as I alluded to earlier when I listed the changes to IS1 since 2005, over the past years, the ISB, or the past 20 years, the ISB has actually been constantly trying to improve the consistency of financial reporting under IS1. To this end, the ISB has been constantly working to clarify the relationship and therefore how entities should interpret that relationship between the need to provide material information for decision making and that black letter requirements in IS1 that specify the specific line items that each of the primary financial statements should include. To address this, the ISB included paragraphs 21 to 23 of IFRS 18, which now provide context for applying paragraph 24 of IFRS 18, which is the old requirement in IAS 1 that's actually specified those additional line items, and subtotals should be included if certain criteria are met. So let's look how these new let's look at how these new paragraphs actually hang together. I talked about it a couple of slides ago, but in developing IFRS 18, the ISB sought out feedback and research regarding how users of financial statements actually use the information contained in the statements, and they found that users pay more attention to information presented in the primary financial statements and use it more frequently than information disclosed in the notes because, among other things, information in the primary financial statements is more structured than the equivalent information in the notes, and therefore it's more easy to use. So to compare entities, to get an overview of what's going on, how has the entity changed over the past 12 months, that sort of thing. So the ISB have taken this as effectively, well, it appears they've taken this as their guiding principle in paragraph 21 of IFRS 18, and they've provided an overlay in the form of paragraph 22 of IFRS 18 to help entities understand what a structured summary in a primary financial statement might look like. And it's worth emphasising that this phrase structured summary keeps coming up over and over again. So the idea that becomes the guiding principle in your assessment when you're preparing a set of financial statements under IFRS 18, is this providing a structured summary or not? And that's what's really should be making that determination about whether or not, if I include something or I don't include something, is it providing a structured summary of the financial position effectively or performance of the entity through those primary financial statements? So let's take a look at the requirements in paragraph 22, applicable just one. I've sort of provided those paragraphs there. I won't dwell on them, but they're relatively straightforward. Actually, I might just, for the quick second, I might actually emphasise a couple of things in them because it's worth noting these things. The paragraph, so on the left-hand side there, paragraph 21, identifying the role of primary financial statements to provide a structured summaries. That was the point I was trying to just make, was the idea that this phrase structured summary keeps popping up again and again, that are useful for the purposes specified in that paragraph. So the ISB have got in their mind sort of a two-level thing where they say, we think that this structured summary that we tell you is how we think the financial statement should be laid out. That's what we think is the base structured summary. As a consequence, that's sort of the black letter requirements now going forward under IFRS 18. And they make it clear there, so in paragraph 21, when they say, an entity shall use the role of the primary financial statements to determine what material information to present in those statements as set out in paragraphs 22 to 24. So what they're actually saying is, subject to the information being material, those structured summaries are how you will assess what is to be included in your face of your financial statements and what's to be excluded. Paragraph 22 provides sort of an interesting clarification, but what it's doing is actually just reinforcing that fact that to provide a useful structured summary in a primary financial statement, entities shall comply with specific requirements that determine the structure of the statement. The specific requirements are, so they've actually identified the paragraphs that you have to comply with when you're preparing financial statements under IFRS 18 that will give you, at a minimum, the structured summary that you're required to do. So in fact, you can see where the ISB's thinking now is moving away from, like previously, I think we always thought the structured summary was those long list of line items that we sort of would have to follow. Now what the ISB is saying is, no. What we're trying to do is move away from that tick list approach. What we want you to do is think about structured summaries. You know, when we're thinking about the face of the financial statements, what presentation will give people the best information that they can get to be able to make the decisions that we think that they're making using those statements. And that's the basis on which you should be preparing those financial statements. So structured information. So it's interesting. So I've put in there on this slide, again, apologies for the wordiness of the slide, but it's a bit hard to sort of demonstrate this information without maybe quoting the actual paragraphs. Paragraph 96 there, we'll start there. So an entity shall present current and non-current assets and current and non-current liabilities as separate classifications in its statement of financial position in accordance with paragraphs 99 to 102. Current versus non-current, structured, we've always had it, so it's not changing. So you can see where the ISB have said, look, when it comes to the statement of financial position, paragraph 96 and 104 they're the basis for your structuring. So current and non-current, we've always had that, so that structure, makes sense. Paragraph 104, an entity shall present the statement of financial position, non-controlling interests, and issue capital and reserves attributable to owners of the parent. Again, a structure that we've always had. So if you've got non-controlling interests, you deal with it that way. and you make a distinction between that attributable to the non-controlling interests and those attributable to everybody else. So that's the basis of the structure. So where does then paragraph 103 fit in? Now, paragraph 103 there on the other side of the slide should look familiar to you. I haven't included all of that paragraph there, but that's effectively a lift and shift from IS1 to IFRS 18. Entity shall present the statement of financial position line items for the following. Now, it's interesting, the ISB have actually said that's not that, okay, that's there to help, but it's not, it doesn't provide a structured summary. What this paragraph does is actually sort of almost, and I think the ISB is almost saying this is a checklist for you to think about things, but not necessarily put these things in. There's been a long ongoing discussion, and it got to the point where the ISB actually did make amendments to IS1 around this, but there was a long discussion around, if you tell me that I have to disclose, say, let's say in this case, goodwill, in my financial statements. Do I have to disclose goodwill irrespective of whether or not it's material? And the ISB had to actually go and amend IS1 to make sure that that was clear. It's going, well, no, this is a list of items that you would, we thought if they were material, we'd expect you to disclose them. But if they're not material, then we wouldn't expect you to disclose them, because materiality determines all disclosures, all level disclosures. So it's interesting what the ISB now doing is actually separating out under IFRS 18. They're saying there's a certain structure, and you get that structure right, then you need to work your way through the individual items and to try to determine whether or not they would actually be on the face of the financial statements, subject to the criteria that we've identified that gives a structured summary. So when you get to paragraphs like paragraph 103 and 75 of IFRS 18, so those are the ones on the previous slide that gave that long list of things that we'd see in the P&L or the balance sheet. Paragraph 23 of IFRS 18 provides the following guidance, which states that some IFRS standards require specific line items to be presented separately in the primary financial statements. For example, paragraph 75 and 103, an entity need not present separately a line item in a primary financial statement if doing so is not necessary for the statement to provide a useful structured summary. This is the case even if the IFRS accounting standard contain a list of specific required line items to describe the line items as minimum requirements. So what the ISB is doing, really reinforcing the fact is the structured summary is different from the line items. Okay, you have your structured summary, which is what we expect all of our primary financial statements to look like, and then we've got these extra line items. Now, when it comes to, and so maybe to run the risk of dwelling on something. So just to reiterate, paragraph 23 of IFRS 18 clarifies an entity need not present separately a line item in a primary financial statement if doing so is not necessary for the statement to provide a useful structured summary. And this is the case even if the applicable IFRS accounting standard or standards contain a list of specific required line items or describe the line items as minimum requirements. So that's what paragraph 23 is actually telling us. So it's pretty clear. Then this begs the question, so what do we need to do to assess whether presenting separately a line item in a primary financial statement will provide a useful structured summary? Well, we go back to paragraph 16 of IFRS 18, which I provided in the previous slide, and which I've reproduced here on the right-hand side of this slide, which tells us what a structured summary looks like. That is, it features, it exhibits, which are, it provides an understandable overview of the entity's recognised assets, liabilities, equity, income, expenses, and cash flows. It enables users to make comparisons between entities and over time for the same entity. And it identifies items or areas about which the users of financial statements may wish to seek additional information in the notes. So in that situation, so the ISB is actually making it absolutely clear that a structured summary has to meet those criteria. So you have to think about it in terms of, have I got my recognised items in there, assets, liabilities, and so on? Do I think it enables users to make comparisons? So I have to think about maybe what my other competitors or other entities that maybe that are going to be, entities that are comparable to me or entities that are in the same industry as me, that individuals might be looking at for comparative purposes. What are they doing? How are they doing it? And identifies items or areas about which you might go and delve into it further. So there is an element of making the selection about how you present on your face your financial statements if things are different. And that's that aggregation, disaggregation question. But in this case, it's really focusing on not everything has to be in the face of the financial statements. Details that are specific to some items, which may be generic or less than generic, they may be best disclosed in the notes, and doesn't necessarily mean that they need that those features necessarily drive the presentation on the face of the financial statements. So, during the ISB's deliberations on IFRS 18, stakeholders informed the ISB on their concerns about the presentation of additional line items and subtotals when they are not specified in IFRS accounting standards. Now, the stakeholders said some of these additional line items and subtotals can be misleading. Now, therefore, the ISB actually decided to amend the corresponding requirements in IS1 to produce paragraph 24 of IFRS 18, which I've reproduced here on this slide. An entity shall present additional line items and subtotals if such presentation is necessary for a primary financial statement to provide a useful structured summary. So you can see the thinking behind the ISB's distinction between structured and non-structured is clear in the IFRS 18. It wasn't so clear in the IS1. When an entity presents additional line items or subtotals, those line items or subtotals shall comprise amounts recognised and measured in accordance with IFRS, be compatible with the statement structure created by the requirements listed in paragraph 22, which I mentioned before, be consistent from period to period in accordance with paragraph 30, and be displayed no more prominently than the totals and subtotals required by IFRS accounting standards. Now, some of those criteria you've probably heard a little bit before, but they're interesting to think about in the sense that what the ISB is saying is that, yes, you can add additional line items and subtotals, but you really have to you will only add them in circumstances where, so they weren't willing to preclude all situations because they felt like that would obviously preclude opportunities for entities to make their financial statements better. But they're obviously conscious of the fact the stakeholders said, look, if you start adding line items and subtotals, that can make it more confusing. So when we look at that, we look at those criteria, I've just jotted down on the right-hand side of that slide just sort of where that takes me. So they've introduced those additional criteria to be met in order for additional line items and subtotals to be provided. So when you're thinking about adding an additional line item or subtotal, you need to think about those criteria and maybe even document it in terms of your financial statements, because and as a position paper for your auditor, principally because there may be some judgments involved in there. It's clear the ISB responded positively to that feedback from the stakeholders, but they obviously they weren't willing to cut off the entire ability to, add additional line items and subtotals. And to minimise clutter and confusion, so paragraph 24 of IFRS 18 includes those additional criteria. They make sense, and I suppose maybe the last criteria there for those who've been involved in preparing financial statements in Australia, who've watched what ASIC say. That is one of the issues that ASIC often talks about. But if you broke those down, you might say, well, look, amounts must be IFRS compliant, sort of makes sense. Consistent with the structured summary requirements in 22, well, you've already put those in place, so we have to comply with those. Consistently applied over time. Like, I think in that situation, I'd be thinking, look, if this is not recurring, that might be something that would indicate that maybe that additional line item or subtotal might not necessarily be included, particularly if it's likely to be removed next year or the year after. Display with no more prominence, like I said, anyone who's dealt with ASIC would have seen that before, and obviously that their concern is that by adding subtotals or extra line items, an entity might be trying to clutter or mislead disclosures in their financial statements around that particular line item. So, new principles of aggregation and disaggregation. I mean, we've sort of been doing it for a long time, and it's interesting the ISB have now decided that they need to sort of consider whether or not those things need to be dealt with. It does make sense, though, in the context of the requirements the ISB have sort of put in place, because what they're trying to do is really probably put more bells and whistles or belts and braces around effectively how you present in your financial statements, but also what you present. So the idea that aggregating, there may be sort of aggregation additional aggregation you can do in your financial statements, which would assist meeting those criteria in paragraph 22 of IFRS 18. Again, sorry for the wordy slide, but if we consider what paragraph 41 of IFRS 18 is actually telling us, at a very basic level, what it's saying is that, well, there's a couple of bits and bobs. So the first sentence is really saying, look, for the purpose of this standard, think about when I say an item, it could be an individual item or it could be an aggregated item. That's what makes sense. A line item isn't an item that's presented separately in the primary financial statements. Okay, that's what they mean by line item. Other material information about items is disclosed in the notes. So they're just saying, look, not everything goes in the face of the financial statements. You can include stuff in the notes, unless and that stuff can be material. So don't make the distinction of what's material goes on the face of the financial statements, what's immaterial goes in the notes. It all has to be material. but you can push some material information to the notes subject to the criteria in paragraph 22. Unless doing so would override specific aggregation or disaggregation requirements elsewhere in standards, you're going to classify and aggregate assets, liabilities, equity, income, expenses, or cash flows based on shared characteristics. You're going to disaggregate it based on characteristics that are not shared. You're going to aggregate and disaggregate items to present line items in the primary financial statements to fulfill the role of the primary financial statements. So that is providing that useful structured summary. Hopefully now you can see where they're coming from, is that it makes more sense to include sort of aggregation and disaggregation criteria when you've said, I've got to have a structured summary. So the financial statements have to be a structured summary. That makes sense then to include aggregation and disaggregation. We're going to aggregate and disaggregate items to disclose information in the notes that fulfills the role of the notes, and ensure that aggregation and disaggregation don't obscure material information, which the ISBs have always sort of indicated. If we break this down a bit further, so paragraph 41 was the principle effectively when attempting to understand if more or less aggregation is required. But IFRS 18 requires other guidance to help entities apply paragraph 41 consistently as compared to each other entities and over time. I've included there paragraph B17. Again, apologies for the wordiness of the slide. But I think it provides a reasonably high level description when it states that, to apply the requirements in 41, entities shall aggregate based on shared characteristics. That's aggregate items that have similar characteristics, and disaggregate based on characteristics that are not shared. So in doing so, they've identified these things, and there's some useful guidance there, and I've sort of expanded out on the right-hand side of the slide here. But the useful guidance is, okay, assets, liabilities, equity, income, expenses, and cash flows. We'll identify those and other transactions and events based on where they're coming from. That can help, and that can help in terms of aggregation initially. You're going to classify and aggregate assets, liabilities, equity, income, expenses, and cash flows into items based on their characteristics. So nature, function, measurement basis, so as to result in the presentation of the line items and disclosure in the notes that have at least one similar characteristic. So when people are looking at a group of items, they should be sufficiently similar to have similar characteristics that you can actually talk about them as one line item. And disaggregate items based on dissimilar characteristics. Now, I've listed there on the right-hand side of the slide sort of the kinds of things that I'd sort of anticipate entities would be looking for. So nature, and obviously we're talking about nature, we're talking beyond assets. So just because it's an asset doesn't necessarily mean it can be aggregated with every other asset. And the same with liabilities. And I'll talk a bit more about that in a minute. But so nature is really the underlying nature of a particular category. The function, the frequency, is it recurring? Measurement basis, size, geographical location, and regulatory environment might differ and therefore have different impacts on that item. Tax effects, it arises from initial or subsequent measurement, or another characteristic. So shared characteristics are more likely to provide structured summaries. So the idea is there's probably a multiple of things where you look at and you'd say, look, there's any number of ways we could sort of cut and die this group of items, and you'd probably be looking for how many of them have the same shared characteristics, and is that shared characteristic probably useful to users to understand if they were looking at it as a single line item in a structured presentation in the statement of financial position or profit or loss. Another thing that might link up particular items might be whether they arise from similar transactions or events, and particularly if they give rise to material information. So the materiality aspect is all important. If it's not material, it shouldn't be there. Now, I've provided here, this is literally an extract from our BDO Global publication, but I thought it was a good little table that helped to sort of work your way through. If you're trying to sort of get a sense of when I'm trying to aggregate things, often understanding why you wouldn't aggregate them will help you to sort of understand also how to aggregate them. So I thought this was a good little table to sort of assist with that process and maybe the thinking. But if we just pick out a couple of line items, if I just start at the top there, nature, salaries and wages versus depreciation, property, plant and equipment, I mean, you can see that they would have dissimilar characteristics when you think about it. Salary and wages, I'm paying to people. It's expenses incurred for people that were doing things for me, that facilitated processes in my business that allowed me to sell goods and services that generated income. Property, plant and equipment probably does the same. It's providing me services, but that's being generated probably from something I've prepaid in the past, or maybe a contract I've entered into now, so like for a lease. And it's almost a passive expense. It's the expense I've incurred upfront to be able to use this particular item. So again, very different in nature, different characteristics. I think you've moved down to the measurement basis one too. Like that's also quite helpful, because when I think about measurement basis in terms of particularly financial instruments, um, if something's classified at fair value through profit or loss, it's probably got very, very different characteristics than, say, something classified as amortized cost. Now, we know that to be classified as amortized cost, you've got to have basically contractual cash flows. Whereas something that's at fair value through profit and loss probably doesn't have contractual cash flows. It's going to have cash flows, but they're not contractually determined. So the timing and amount are not contractually determined. And so when we're thinking about those things, if I was a user, it's interesting, because what that tells me, not just the measurement basis, so disaggregating on measurement, but what it's disaggregating on the basis of what the cash flows are going to be like. And so what I could expect that the cash flows might work. Another way of thinking about it too, which is interesting, I sort of thought about when I looked at this table, was there are, opportunities within, say, IFRS 9, where you can fair value something through profit or loss, or you can designate an entire instrument to be fair value through P&L. And often we see that with financial liabilities that are hybrid instruments, where there's like a debt instrument plus a embedded derivative. Some entities, often what they'll do is that rather than trying to split out the two instruments and fair valuing one and applying amortized cost to the other, they actually just designate the entirety at fair value through P&L, because they go, look, it's a debt instrument, but if it's got an embedded derivative that's, material, typically that means it's a different type of funding. Like it could be that it might be funding that's been provided by a particular type of contributor. It could be like a PE firm or something like that has provided that, because they want some upside in the entity, and that's why the embedded derivative exists. Now, the entity might fair value through profit and loss the entirety of it, just to deal with the fact that, like, rather than having the value of value, just the embedded derivative, we'll do the whole lot. It's just easier. But in doing that and classifying in that way, it says something about that instrument that's probably different, and therefore not maybe comparable to your vanilla bank loan. And so as a consequence, measurement basis can be quite a strong indicator, not just of differences in the way the numbers might play out, but also differences in the underlying instruments, but also differences in the underlying way that the entity sees those things. And so I do think that thinking about wise differences can help to understand why things should be the same as well. So whether I aggregate or disaggregate. The table provides a couple of different examples, so it's quite useful to sort of think about when you're trying to understand where things go. Classification and presentation of expenses by nature and function. This is an interesting and long-running one. It's a perennial issue, and it's a perennial question. Up until now, basically, IS1 has required entities to categorise and disclose expenses based on either nature or function. And there wasn't much flex in IS1. Having said that, certainly it's probably been I'll say this, least complied with part of IS1 probably over a long time, and it's probably been dealt with by entities because it's not material. And in my experience, what I've seen is that entities typically, when they do a mixture of nature and function, and typically they're doing it because they think that it gives better information. I don't think they're trying to mislead when they do it. I think they genuinely believe it gives better information, because there might be parts of their business which are people are more interested in. So function might be something that they go, yeah, look, I'm interested in function. I don't need to know the individual expenses of that function, but the function's useful. Alternatively, they might look at it and say, the individual items, the nature of those items are relevant to me. So I'd really like to know how much you spend on employees totally, something like that. So I don't think entities have necessarily been trying to hide anything by it, but I think what their actions have been really is focused on trying to give the best information to users. But interestingly, the ISBs have identified that, and so paragraph 78 there, and I've provided I've reproduced it there on the left-hand side of the slide. In the operating category of the statement of profit or loss, and I've emphasised the operating category, so it's not in any other category, an entity shall classify and present expenses in line items in a way that provides the most useful structured summary of its expenses using one or both of these characteristics. So nature or function. So they continue with maker and function, but they've actually just eased it up and said, okay, well, you can do it as a combination. Now, what that does is create some additional challenges, and I suppose overriding the thinking that the ISB had is they probably are in the back of their mind saying, look, previously under IS1, for example, where you classified things by function, we used to say that you had to disclose, in addition to that, total expenses for certain categories, so things like employee benefits expense. So, and I'll come back to that, but it is relevant to this, is that when you start mixing the categories up, then it probably does, particular function, it does tend to, you lose detail around certain line items. So the kinds of things that have popped up and the way they sort of work their way through it, the ISB have identified a couple of things that you sort of need to keep in mind. So if by giving the choice between nature and function, then you've got to realise that any individual line item comprise expenses aggregated on the basis of only nature or function. So you can do nature or function, but in line items, it has to be all nature or all function. You can't necessarily mix up within line items nature and function. So you can have line items that are nature, line items that are function, but not within the line item. Now, if nature is used, provide information about operating expenses related to the nature of the economic resources consumed to accomplish activities with reference to actual activities. So sometimes you need to be aware that within, obviously, function, there'll be, by nature, there'll be underlying that, there'll be some expense line items that maybe users want. And so you might need to actually include, you need to actually disclose some of that additional information. Now, if its functions used, allocate and aggregate expenses according to activity to which consumed resources relate. So nature, no longer important. It's about the function. So be clear on what the function is and the expenses that go to that function. And if functions used, present a separate line item of cost of sales, disclose qualitative description of the nature of the expenses included in each function line item, and disclose a single note single note of various expenses by nature. So depreciation, amortization, employee benefits, and so on. So you can see with the nature function, whenever you move towards the function again, the ISB has taken the view that there is some information in the function that we'd like carved out, which is based on nature, and therefore we probably need some additional disclosures. So you need to be aware of that. So new expense disclosures. And this is sort of related, obviously, to the last slide, the idea that we have this issue of detailed note disclosures when function classification is used. Some information can get hidden. I've provided there on the left-hand side of the slide a summary of basically what the requirements in paragraph 83 are. So it does break it down. It does identify pretty much consistently with IS1, things like tell us about depreciation, tell us about amortization, tell us about employee benefits, impairment losses, write-downs and reversals. So the key things are still sort of there from IS1. Difference is there is that part B. So for each total listed above, the amount related to each line item in the operating category and a list of any line items outside the operating category that also include amounts relating to the total. So I think the best way to disclose this is, or describe this, is probably using examples. So I've provided here, I've taken this from our BDO IFRS in practice publication. We start with example 1. Entity H classifies all of its operating expenses by function in the statement of profit and loss. Certain expenses are specified by IFRS 18, paragraph 83, are also presented in categories other than the operating category, so e.g. depreciation of investment property measured at cost, which is presented in the investing category as entity H does not have a main business activity of investing in investment properties. Okay, so entity H must comply with disclosure requirements in IFRS 18, paragraph 83. So what does that look like? So in terms of the detailed note disclosures, when function classification is used, this is probably what you're looking to have to do. So having to be able to understand, and this does raise questions about the capacity of your internal systems to track costs by nature and function. And so it's something that you should be aware of if you move towards that function classification, that you will still need to be able to identify expenses within the functions by nature. And then breaking them down to the total. So you can see there, and as you can see in the slide, breaking down depreciation of property, plant, and equipment, investment property, how it's spread across the various categories. So cost of sales, research and development, administration, how the employee benefits are spread across those line items, and the totals. So keep in mind you don't need to disclose the totals, but you need to be able to add them across those the various components. It's interesting there, the depreciation of investment property, because it's a part of investing category, it doesn't appear in your operating profit or loss number, and so within your operating statement under IFRS 18. And so as a consequence, then you have to sort of note that it's disclosed separately in a different line item. That's taken us to the end of it. Hopefully I've given you a reasonable overview of what the potential implications of IFRS 18 are beyond the profit and loss statement. We are going to do a masterclass on this, and so for those of you who are interested, certainly, and I'll provide the details in these slides. If you're interested we'll be doing pretty much what we did in the profit and loss masterclass, where we're going to be using a worked example, and we'll probably cover things like, obviously, classification of expenses by nature or function. We're going to be looking at, obviously, things like how aggregation and disaggregation, and obviously what structured summaries mean in terms of a primary financial statements. Some of the resources we have available, I mentioned it before, we have obviously the BDO Global IFRS in Practice publication, but we've also got our CRI publications, which, like I said, every one of these webinars that I'm doing, so for the subsequent CRI publication, what I'm going to do is do a little summary, maybe hit on a couple of points that I thought were significant, include possibly a little bit more explanation or a little bit more of an opportunity for people to sort of read it and sort of understand and get a bit of an understanding of exactly what those particular requirements are. Mentioned the masterclasses, but they're still up and available. Like I said, I'm going to, and I'll let you know certainly soon as, we will schedule another profit or loss presentation masterclass, probably in somewhere around October, probably during October. Again, it'll probably be a Friday, probably be around midday, basically to ensure we can accommodate as many people as we can, so we're not forcing people to get up at sort of stupid o'clock in the morning to basically attend. But what we're going to be really trying to focus on, again, there's practical examples. In this case, we'll look again at the P&L, but the two other masterclasses are still available for those who haven't actually registered. I mentioned before the corporate reporting insights. You can get registered for that basically on our BDO website, and we've provided the links there. And our corporate reporting learning hub's also available. So obviously, if you want to watch the webinars or enroll in webinars, we've also got online seminars and engaging e-learning content as well, which is available on that through that link. We've got you've obviously got direct access to corporate reporting experts, and in terms of our BDO lead, the dashboard is something that we've been raising with clients over the last couple of months, particularly the BDO lead clients, to give them a better access to the information around strategic decisions for the purpose of strategic decisions around their leasing. Sorry, I just missed that, but obviously they're the details to our IFRS and corporate reporting partners around Australia. We've got Lynn in Adelaide, Letta and myself in Melbourne, Kevin in Sydney, and Clark in Brisbane. And sustainability reporting, there are your contacts for sustainability reporting. That brings us to the end of the webinar today. I hope you got something from this. I hope it was helpful, and we will talk to you very, very soon. Great. Have a good day.